There are about 18,000 autos in the backlog in the US. The last hour of the day saw a 2% increase in this stock. Here, buddy, I'm changing gears in a place with no gears. Okay, I'm changing gears now. The current backlog is for 13,000 autos, much like in China. Since Tesla now has recurring revenue, it makes sense that it has appreciated as much as it has over the past month despite all of these announcements. As you can see, they are altering the business strategy, which is great, but at the same time, the market capitalization of the stock increased by $300 billion. To charge their electric cars, people will be using a different kind of connector. Tesla each and every time? No, they aren't. Do you know why? The wait time is the shortest it has been in years, and they are giving out free supercharging for 3 years if you want a Tesla right now. Alright, so this is going to be the best thing ever. It will be the most valuable commodity. There's such madness going on here, people, and I just don't understand. Everyone assumes that this is the norm. Have you heard about the incredible spike in Tesla's stock price over the last 10 days that has many bearish panicking? We'll go back to some of the most outspoken critics, such as Tim and Dan, and examine how their positions have changed in response to Tesla's unrelenting expansion. Once a fervent Tesla skeptic, Tim has changed his mind, while Dan is still having trouble keeping up with the stock's meteoric growth. We'll then turn our attention to Tesla's energy division, which is at last receiving the recognition it merits. We'll examine Morgan Stanley's most recent energy model, which indicates that Tesla Energy may be worth more than the automobile division. With breakthroughs like the Megapack and notable expansions in energy storage installations, Tesla Energy is well positioned to defy conventional market assumptions. We'll get a thorough grasp of the present state of the Tesla business and the expanding energy industry in this video. This movie provides something for everyone, whether you're a seasoned investor, a Tesla enthusiast, or someone searching for fitness and health advice. Remember to hit the like button, sign up for Tesla stock news, and return soon for more interesting stuff. Let's get started now. Tesla's remarkable 10-day stock jump is highlighted in a recent CNBC broadcast. It's important to note before the video begins that Melissa Lee frequently conveys a lot through her facial expressions. Tim, who was once a harsh critic of Tesla and foresaw its demise, had a dramatic change of heart. His wagers didn't work out, and he was well known for shorting Tesla's shares. Dan Nathan of Risk Reversal Advisors, who appears to lose his temper whenever Tesla's stock rises, has now been brought on by CNBC. Although it's only a theory, it's plausible that Dan's outbursts are related to financial losses he suffered when shorting Tesla. That's what his theatrical responses imply. Melissa Lee's responses to Dan's antics, meanwhile, are so precious. Is it possible that she is secretly taking pleasure in Dan's discomfort? Let's investigate. The thrilling stock run of Tesla is the first topic of conversation. The topic of when those robo-taxes will be on the road comes up. Tesla's stock fell to about $138 a few months ago, and it is currently trading at $262. Investors were concerned about car deliveries back then, but their worries were naive. Due to recent supply chain disruptions and vehicle shortages, market volatility is to be expected in the cyclical automotive industry. Short-term swings don't deter long-term investors. If you're thrilled about Tesla's stock price increase, you're undoubtedly considering robo-taxes and other cutting-edge innovations. But let's go back to the time when Elon Musk misappropriated roughly $500 million. This action was misunderstood by some as favoring XAI over Tesla. It turned out to be a calculated move because Tesla wasn't ready to use the NVIDIA GPUs they had ordered. Thus, it made sense to have them shipped to XAI until their facilities were ready. This choice kept Tesla's balance sheet intact and prevented costly hardware from sitting idle. Despite early unfavorable spin, Tesla had a good plan. Building a robo-taxi network requires the H100 NVIDIA chips, but their operation requires a fully furnished facility. Dan would see that delaying delivery was a sensible decision if he were impartial. With short sellers going too deep on Tesla and bears taken off unprepared, the market has been incredibly unbalanced. The company's battery storage division, which had been operating beneath the radar, saw a 100% increase, and its recent deliveries surpassed expectations. Although Tesla has quadrupled its quarterly energy deployments before this in Korea, the stock is currently in an overextended period, even if it has the ability to rise further. Some advise selling now in the hopes that the stock will decline and then searching for a better time to re-enter the market. Nevertheless, this approach entails paying capital gains taxes and holding out hope that the stock would decline sufficiently to justify the investment. Because of its volatility, Tesla might go any way, but the stakes are high because autonomy is coming soon. If robo-taxis become widely used, Tesla's value may increase dramatically. With so much potential at stake, it might not be a good idea to take the chance of selling now. As more people become aware of the full potential of Tesla's energy storage business, the narrative surrounding the company is changing. Tesla Energy might grow to be as large as its automobile sector, if not more, as Elon Musk has long projected. With Morgan Stanley pointing out the substantial value in Tesla's energy sector, Wall Street is beginning to take notice. Energy demand is rising across generations due to generative AI, and interest has grown as a result of Tesla's Q2 energy storage beat. Furthermore, the scale at which Tesla is ready to operate is demonstrated by its megafactory in Lathrop, California, which can produce 10,000 megapacks a year. The enormous profitability of the energy industry is demonstrated by the startling comparison that the earnings from a fully utilized megafactory is equal to the profit from the sale of 1 million Teslas. The story of Tesla is changing as Wall Street starts to recognize these facts. With the potential to upend established energy industries, Tesla is now acknowledged as a significant participant in the energy market rather than just a car maker. Together with its innovation and size, the company's strategic focus on energy storage puts it in a position to benefit from the growing demand for energy solutions around the world. This curiosity about Tesla's energy business is similar to what we may see in the future with robo-taxis. Significant financial gains could result from a quicker and more extensive rollout of Tesla's driverless cars. With a fresh perspective on Tesla's potential, Morgan Stanley has lowered its car expectations while increasing its energy forecasts. It's crucial to remember that analysts refer to new car sales rather than the total number of vehicles on the road when discussing market penetration. Morgan Stanley may be downplaying its energy projections in order to avoid establishing an unattainable price objective for Tesla, according to one theory. To prevent mockery, they might be attempting to balance their estimations. In any case, AI developments and impressive quarterly results have increased investor interest in Tesla's energy division. Analysts have revised their Tesla energy model after a recent in-depth analysis of the company's operations, but they have maintained their $310 price objective. When their revised energy projections nicely counterbalance their lowered EV adoption projections for 2030, yielding the exact same price goal to the penny, it is difficult to believe these analysts. There is doubt over their methodology, since it seems they have modified their automobile predictions to account for the growth in the energy market. The value of Tesla's energy division has increased from $36 per share to $50. Rising China protectionism and a rebound in hybrid vehicles are the reasons for the U.S. battery electric vehicle penetration rate dropping from 25% to 20%. As a result, their core valuation has decreased by $15 shares, and their 2030 Tesla auto sales prediction has been reduced from 6 million to 5.7 million. Solar deployments have slowed while storage has increased, according to Tesla Energy, which focuses largely on energy storage. Currently accounting for 95% of Tesla's energy sales, the energy storage division is predicted to eventually reach 97%. Elon Musk claims that Tesla Energy is their highest margin company, indicating that this area has a much greater margin profile than the car industry. One Megapack 2 XL, for example, sells for $1.4 million, which is the same amount of money as selling 35 Teslas, but it is far more profitable. According to Morgan Stanley, the earnings from selling 1 million Teslas would be equal to the profit from a single, fully operational megafactory in Lathrop, California, which could produce 10,000 megapacks a year. Investors are starting to think that Tesla Energy might be worth more than the company's automobile segment as a result of this change in viewpoint. Tesla's innovation, scale, and increasing brand loyalty, along with its increased focus on the energy sector, present a serious challenge to the market's established participants, according to a clean tech analyst at Morgan Stanley.